Many would say it was only a matter of time after India's outlook was upgraded to positive 2 years ago that a ratings upgrade was in the tow. S&P Global Ratings last week delivered the much talked about upgrade after a gap of 17 years, underscoring the strength of the Indian economy. But is it too late, and will the next one take as much time? Welcome to Beyond Averages, our weekly data podcast where we try to decode the story behind the big numbers. And this week we'll be talking about S&P's upgrade and the road ahead. More than the upgrade, it's the outlook and the forecast for India that seem reassuring. S&P expects Indian economy to weather the global uncertainty storm and grow at 6.8% starting FY27. The economy is expected to log a 6.5% growth this fiscal as per S&P. Moreover, the ratings agency expects the debt to come down to below 80%, around 78%, and fiscal deficit to fall below 6.6% for the general government, that's center and states combined. But does that take us closer to the next upgrade? Not so much. S&P notes that for the next upgrade, deficit needs to fall to 6% on a structural basis. We have with us Gaura Sen-Gupta, Chief Economist, IDFC First Bank, and Dheeraj Nib, Economist at ANZ, to discuss more about the issue. Thank you for coming on the show, guys. Gaura, coming to you first, what does this upgrade mean for India and why has it come now?
So basically, it's a good indication of the hard work that the center has done for the last couple of years post-COVID, where in response, because of the COVID shock, the fiscal deficit to GDP of the center had gone up and to around maybe 9% of GDP. And once things normalized, revenue collection picked up. Now we are on the glide path to a 4.4 fiscal deficit for the center. So it's definitely full credit goes to the center. If you look at the state government fiscal situation, there's actually been a gradual widening. Those states are relatively better in terms of deficit as well as debt compared to the center, but there is a gradual pickup in the deficit at the state government level. So the S&P had earlier also indicated that for this particular upward revision in ratings, the general government deficit will need to fall below 7% of GDP. So in their assessment, this whole consolidation over the last couple of years led by the center has helped get the general government deficit to GDP ratio down. Even if you look at our general government debt to GDP, though it is still on the higher side compared to the other investment grade economies, but we are on a gradual moderation path. So we are moving in the right direction fiscally. That is what the rating upgrade is comes. And also the fact that on the other metrics, India was always significantly better than the other investment grade economies, whether it's current account, growth, inflation, external debt to GDP. In all those metrics, we were better than the other investment grade peers. It was only the fiscal side which has held us back. So this is an acknowledgement of the fiscal consolidation that we've seen at least at the central level.
Dheeraj, as Gaura said, we've become better on other aspects as well, but we are still below Philippines and a few other countries as far as our ratings are concerned. What do we need to do to reach there? Of course, the 6% part we'll discuss later, but what more needs to be done? We are the fastest growing economy. I think we've come out of the pandemic the best amongst all the regional peers. If you look at S&P's own commentary, it talks about amongst emerging markets, India has performed one of the best there. So what more needs to be done on that path?
Sure, Ishan. So I think if you look at the three parameters that have played out in this rating upgrade, the first one is, of course, economic resilience, and India has displayed, ample of it in recording, very high growth rates over the last 3 years, at least relative to the rest of the world and rest of the Asian peers as well. The second is, the macro stability aspect, which I believe is perhaps an important cornerstone of India's economic story the last few years. As Gaura mentioned, it's the current account deficit, the inflation, and lastly, of course, the fiscal discipline. So I think these three parameters remain, the groundwork which will determine when the next rating upgrade happens, and as and when that happens. I really can't claim to know the minds of rating agencies, but I think that if you look at the long-term projections for India, whether it's on these parameters of macroeconomic stability or economic growth, the consensus is that India will continue to outperform the general economic universe. And I think the sticking point here could still be, the fiscal discipline, the fiscal programs. Now, here are a few things that need to be considered. Look, we are gradually going to move away from fiscal deficit targeting to debt targeting from FY27, according to the announcements made in the last budget presentation. And there's going to be a medium-term debt targeting framework. Now, the medium-term debt targeting framework essentially gives the central government flexibility in endogenizing or choosing a fiscal deficit target that lands the government at that medium-term debt target, which is about 50% by FY31. Now, the problem here is that if you work back the numbers, you would realize that the government may not really need to bring down their fiscal deficit target below 4% of GDP or 4 to 4.2% of GDP to achieve that debt target by FY31 if the economy continues to chart a normal course. Now, this means that combined with the state deficits, which again, as Gaurav mentioned, have widened in the recent years, and I think the buck really stops with the central government for further fiscal consolidation, I think the odds are there's not going to be a lot more fiscal consolidation from here on. I'm particularly not averse to it. I think with the kind of macro stability parameters India has, we can afford to run a fiscal deficit of 4.4 or 4.2% of GDP, provided the nature of spending or the quality of deficit remains high or continues to increase. So as far as the next rating upgrade is concerned, I think the bar is high. But I mean, important thing to watch out in the near term is what do other credit rating agencies would do. But this one, of course, one can argue a bit overdue.
That mean that the states will have to do more of heavy lifting going forward if we are to reach that 6% mark that S&P talks about? And is that even achievable in this paradigm?
Look, I think with the states...
Please, go ahead. Gaurav,
why don't you go ahead? I'll just chime in later.
No, it's fine. Please go ahead.
So, I mean, what I was trying to say is that, look, I think the bulk of the consolidation effort in the recent years has happened on account of the central government. And with the states, the situation is already, I think, at the threshold. I mean, the state deficits around 3% of GDP is pretty much where they should be. Consolidating them further, especially keeping in mind the recent announcement in terms of GST tax rationalization, which could have a bit of a, negative impact on fiscal revenues, etc. And we're still to see how this particular down cycle in the business cycle plays out and what impact it will have on fiscal revenues. I think the buck really stops with the central government, which is what I was trying to highlight earlier also, that I really don't expect the central government to very strongly consolidate their fiscal deficits from here on. So if you're thinking of a 6% of GDP general government deficit in which states are about 2.5% to 3% of GDP, then the rest 3.5% is center, which still means about 1 percentage point more in consolidation in fiscal deficit. That I think is a bit of a tall ask given the state of the economy currently.
Gaurav, what's your view on this part? Can the 6% be achieved? Also, do states have to do the heavy lifting going forward? 2.93, 3.2 is what their deficits have been. Can they bring it down to 2.5? And can the center come down to, let's say, below to around 3.5 or 3.6%?
So definitely agree with all the points mentioned. The issue with the states is states. If you see the center is really doing its bit. It's got its deficit down to 4.4. Last couple of years, whatever has been the fiscal deficit target, the center has outperformed. Even if you look at India's reaction to COVID, we were very fiscally prudent. For example, the fiscal stimulus that India gave in response to COVID was maybe 3.2% of GDP. You compare that with a developed country like US, Europe, where it was 25% of GDP. So during that sort of a unprecedented shock, we were extremely fiscally prudent. It's also one of the reasons that now we are, at least in terms of the fiscal metrics, much better off. The states are facing a changing dynamic. The first change is the fact that with GST, states have lost some part of the control over the taxation bit, because now GST is it's like a joint decision. Center has also lost some part of the taxation power, but they still have access to a direct taxes, which a part of which, about let's say 30%, they share with states. But the post the GST, some of the fiscal power of states has come off because of this sort of consolidation of decision making that is now with the GST Council. The other issue that the states are facing is that there is this just in time cash management that the center is doing. So basically, the center will not release funds to state governments for certain set. You have schemes which are jointly funded by center and state. So the center will not release its share of the funding until the states has used up past funds, at least 75% of it. And there is this platform called Sparsh, where for certain schemes which are, let's say, above 500 crores in terms of annual outlay, there is a real time monitoring that is taking place of how the money is actually getting utilized. So, from a reform perspective, this is very good, and this is only going to expand. More and more schemes are going to come in the ambit of this just in time cash management. In terms of the fiscal impact, what you're seeing is, if you look at FY25, when state government fiscal deficit actually went up, it was maybe 3.1%, 3.2% of GSDP, which was, I would say, surprising. That pickup was because transfers from center to states has come down to 1% of GDP, while states had budgeted something along the lines of 1.7% of GDP. So this this is one of this, one, you have less taxation power because of the fact that in the post GST era. Second, you have this just in time cash management that is coming in, which will stay, and it's a good reform. But again, it will force the states to be more fiscally to manage. It kind of limits the access of funding that states get, at least from the transfer angle. It is being countered by the fact that the center has been, I would say, much more forward looking in terms of they give them an extra month of tax devolution. So in FY25, you actually saw the center tax sharing with states has been higher than the budgeted, because they gave certain, maybe three times in a year, instead of giving 1 month of tax devolution, they'll give two. So that in a way has helped a little bit, but the grants from center have come down. So if you notice that the states have actually, there has been a pickup in the deficit. One is the grants, then you've got these schemes that have come in. For example, targeted income schemes, especially women oriented schemes. In many state governments, the allocation to these schemes, it's maybe as high as 1% of GDP, or even higher for certain limited states. So what we are seeing that for states to start getting their deficit down from, let's say, a 3.1, which they achieved last year, to somewhere around to what they used to be, which was a 2.5, will require expenditure compression, which in this sort of growth environment is not warranted. And I completely agree with the point with the center from FY27 moving to the debt targeting. So their target debt to GDP, that gives them more flexibility. Your fiscal deficit does not have to reduce by zero point 0.4, zero point 0.5 percentage points anymore. You can have a much more gradual reduction in fiscal deficit, and still the debt to GDP will be on a moderation path. So I agree that a rating upgrade is always a good thing. It enhances the stability of the economy. Whenever there's a global risk of a better rated economy will be less targeted, but at what cost? So I would still say, at least currently, the way growth conditions are, the fact that we are operating in a very challenging environment, I would still put more weightage that the fiscal policy responds to what domestic growth requires, because the states historically have been very prudent. For example, majority of your 82, 81% general government debt to GDP is because of this is at the central level. If you look at states, they are maybe around 26, 27%. Right now, growth requires fiscal help because you've got Trump, so your export side is a bit battered. Domestically, you have weak urban demand. So right now, the apart from RBI, the only other policy support is the fisc, and we would still say that at this juncture, domestic growth should be given a higher weightage rather than aiming for the next upgrade whenever it
So,
comes.
Dheeraj, coming back to you, because we've discussed this quite on a lengthy detail. On the borrowing part, how much does this help India to, does this lead to more fund diversion at this uncertain time? Because usually there is a capital flight here and there. And so, does this help in certain regard or not?
Well, it's a structural positive. There is no doubt about it. It improves the optimism regarding India's bond market from a structural perspective. But look at where the 10-year benchmark yield is trading today. It's above 6.5% again. So, of course, transient of the last few days, and it's understandable as well. The kind of environment that we're in, it's a lot more. It will take a lot more to bring yields sustainably down further when we domestically think that the Reserve Bank of India has more or less run its course in terms of monetary policy rate cuts. There could be one more, etc., but that's not really going to move the needle very much. So I think in terms of borrowing costs, there is both a cyclical and a structural narrative to it. Cyclically, I'm struggling to think if borrowing costs can come down a lot more from where they are currently. But from a structural perspective, let's be honest, in India's case, it is more the demand-supply balance over the years, which has sort of given rise to this multi-year down cycle in borrowing cost narrative, not so much really a rating upgrade or expectations of that. I mean, if you look at the demand side of the bond market currently, and I'll point you to one direction, which is the demand from NBFIs, the non-banking financial institutions, that is growing at such a rapid pace. It is growing off a small base. I think from a structural perspective, there are going to be many more demand drivers over the next few years for India's, GSEC market, which will ensure that yields will remain, broadly contained, or even if on a downtrend in many years. So I think that this rating upgrade is a good sentiment boost overall. It can improve participation of various foreign investors into the Indian GSEC market, which has already increased in the last 1 year. But over and above that, I would hold my horses. Yeah.
Part of play out on the finances part. The other aspect of it which I wanted to understand from you was what would be the impact as far as RBI rate hikes is concerned, because a lot of this moving of 28% and 18 and 12% slabs would actually bring down items in the food inflation and the core inflation category. So once that is down, does RBI have more room? Can it go to 5%, or is it still 5.25% that you'll see?
In October of 25 basis points with respect to the growth inflation makes sense. Now, as far as the rationalization of GST tax rates and inflation is concerned, look, of course, the common consensus is that it's going to be deflationary or disinflationary. So the impact, I would really not hazard a guess as yet. People have given, estimates of about 20 to 50 basis points of downward revisions to inflation forecast on the back of GST tax rationalization. But let's be honest, there is much less pricing power in the economy right now. Profit growth among firms has, in aggregate, been not great. I would really struggle to think that if the benefits of these tax cuts would be immediately passed down to the consumer prices. So overall, again, I would say it's a structurally positive thing as far as inflation is concerned, more so as far as domestic consumption is concerned or disposable incomes are concerned. But in the course of next 6 to 12 months, I think the full impact will not be realized. So I would say that the Reserve Bank of India goes once more with a 25 basis point rate cut in October, but that would be more to do with growth. My own assessment is that domestic demand indicators have weakened, and I think RBI's 6.5% growth forecast is looking a bit optimistic at this juncture to me. So it will be more to do with growth. As far as inflation is concerned, look, 4 quarters ahead, inflation is still 4.5%, if not the RBI's 4.9%. I think 4.5%, if you look at historically, has been the threshold at which the Reserve Bank of India can be more or less okay to stay put and not move the monetary policy in any particular direction.
So on the growth part, how much does a help come from income tax cuts and the GST cut? And is that enough to tide us through the global uncertainty? Because at some point of time, I was reading a few reports, they were talking about a 0.2 to 0.5 percentage point drop in the GDP because of the tariffs and other issues. So does this kind of make up for that, given the consumption boost that we would get, or would we still lag? And how long do you see these effects continuing? Of course, we'll adjust, some of the trade would be bypassed, but how long do you expect these effects to continue, or would we bounce back faster?
So it's tariff versus tax cuts. And I think it's a very complicated equation currently. And estimating the quantified impact of any of the two is very, very difficult. I'll tell you the basic reason why. I think the economy is going through a cyclical downswing. Whether you look at credit growth, industrial output growth, core sector growth, or whichever high frequency indicator of importance you look at, it is not doing great at the moment. So it will be very difficult to disentangle the impact of tariffs or tax cuts on aggregate growth that you can observe in the GDP numbers, etc. But let's for the sake of it, consider the pros and cons of these two aspects. Look, I think the tariff shock is not just an export revenue shock. I mean, we have about 1 to 1.5% of GDP exposed to US demand, which could actually suffer because of very high US tariffs. At 50%, most exports to the US that are subject to those tariffs become commercially unviable. So I think that a direct hit to export revenue may not be very much. It could be 0.2 to 0.4% of GDP, which is manageable, to be honest. But it is the downstream impact on sectors like gems and jewelry, textiles, which are extremely employment intensive, which is more worrying as far as my view is concerned. And I think we've heard some negative news flow in the last couple of weeks, some 100,000 workers being preemptively laid off because of the expected impact of tariffs in the gems and jewelry sector. Of course, these are informal jobs. These are people who are earning much less in terms of their daily or monthly wages. So there is, of course, going to be a knock-on impact of consumption, knock-on impact of credit, knock-on impact on other aspects of the economy, which will be worrying. So estimating the full impact of this tariff is problematic. It could be much larger than 0.2, 0.3% of GDP, especially if they stay at 50% rate, which is actually quite prohibitive. But the bottom line here is that it is an income shock. And an income shock and a job shock can actually be a potent combination or a potent headwind to the Indian economy at the current juncture. Now, compared to that, consider the tax cuts. The income tax cut, which was announced in the budget presentation, has virtually evaporated. I mean, I don't really think any one of us can really say that we have seen a very strong positive boost to any of the indicators that we track because of that income tax cut. And it was understandable. Household balance sheets are quite leveraged at the moment. And if at all they have got any amount of savings, some of that could go towards debt servicing, and it's also an economic down cycle. So some of that could be, used to replenish precautionary savings, etc. So I think the income tax cut has not really shown up much in economic activity so far. As far as the GST tax rationalization is concerned, I think it helps in the sense that it increases disposable income in the hands of the people. I would have argued back when income tax cut was being announced that an indirect tax cut is a better idea than a direct tax cut, but I think it has come a bit late, but in good time. So I think it will improve disposable incomes a bit, but would it drive consumption to drive GDP growth in this particular cycle? I'm not very sure. So I'm more optimistic with respect to GST rationalization from a structural perspective, from a, let's say, a 3 to 5 year growth perspective than that. But international experience, I would say, is that indirect tax cut have a short-term boost to consumption, but in the long term, they have to be matched by income and job boosting reforms or measures. Only then they turn out to be much more successful.
Gaurav, we've made Dheeraj talk a lot. I think we had lost you in between. So I'm going to come back to you, ask a few questions regarding that only. One of the interesting things that I was looking at the S&P part was the aspect of savings ratio in the economy, which is actually not very high, not back to the levels that we are seeing. How big is a problem? How big Is that a problem? Two, on the RBI aspect, as Dheeraj and I were discussing, with the GST rate cut coming in and impacting both core and non-core items, food items, basically inflation, does RBI have more space as far as rate cuts are concerned? Can they go down to 5%?
Okay, so I'll start with the savings bit. So it depends which, if you're referring to household savings, yes, they have come down. From FY24 itself, which we have the data, household savings is maybe around 18% of GDP, which is lower than what we had pre-pandemic. So there is that savings buffer that we had generated during the pandemic when people were working from home. They were not spending, let's say, on a lot of contact intensive services, less expenditure on travel. There was a savings, household savings had shot up to maybe 22% of GDP. Now that saving buffer has been used. So you are seeing that impact in terms of the urban side, the urban weakness that you're seeing. It's a combination of the fact the savings buffer is gone. If you're talking about savings at an economy wide level, which includes households, government, corporate, that there I think the challenge is less. The I would say the best indicator for in economy wide savings is the current account. The current account is basically the gap between domestic investment and domestic savings. So whenever domestic investment exceeds savings, you import foreign savings to bridge the gap. That's what current account actually is telling you. So India for the last couple of years, we have sustained quite low current account deficit. Last year we were only 0.6% of GDP. We used to be a 5% deficit economy. And obviously five is was one of when we got embroiled in the taper tantrum. We also got clubbed with the fragile five. But since then, our current account gap has only shrunk, and it's now the sustainable level as per RBI is 2.5% of GDP, and since the last couple of years we've been comfortably below that. So the economy-wide savings is not an issue. So yes, household savings has come down, but you see pickup in corporate savings. You've seen this savings by the government, thanks to the center, has come down. So that is also helped. The other question that you were asking regarding GST impact. Now, well, I would completely agree with the statement that indirect taxes have a better growth boost than direct taxes because the number of proportion of people who actually paid positive income tax was very small proportion of the population, while the number of people who will actually benefit from the indirect tax, for example GST, goods and so many goods and services. So a large part of the consumption, a large number of consumers will actually see first hand benefit. So we do expect some support to growth. And as per us, it depends how soon they are able to roll it out. This is a proposal by the center. It has to be approved by center and states. And given, let's say, the PM indicated that it should be before Diwali, so let's say from October onwards. So the impact will be, let's say, more second half of FY26, first half of FY27. As per our estimate, a 12-month sort of boost to growth will be around zero point 0.6 percentage points from this sort of move. And so, what the good part is that the center is, if you see off late this year, the center is becoming more fiscally active to support growth. They used income tax. Yes, the efficacy of an income tax cut is limited, and it'll compared to the indirect tax cut. But now they have come with this proposal, which they'll have to work with the states to get it through, to come within a substantial income indirect tax cut, which will help, let's say, consumer durable consumption, where a large number of items which were in the 28% bracket will go into the 18% bracket. Even for food, you'll see a large number of processed food items which were at the 12% bracket, they will go to the 5% bracket. So you will see a little bit of support for growth, plus you will see a downside moderation on inflation. So on a 12-month time period, inflation overall can go down by about zero point 0.6 percentage points. It depends how much is actually passed through. So hence, the estimate could the I would say range between zero point 0.6 to zero point 0.8 percentage points, but it depends on how much is passed through. But again, you will see the effect on food as well as core items. And so this last this year has been, you've seen RBI front load rate action, and now the center is coming. The other part where the fiscal is actually coming in is the capital expenditure, which is also picked up both center and state level in Q1. So it's showing you that both monetary and fiscal policy is coming together.
Last question to you, Gaurav. On the fiscal part, this GST would have diverse effect across states. Some of the states are more dependent on GST revenues as part of their own tax revenues. You look at a Bihar, 61% for FY25. You look at some of the northeastern states, they are above 70%, most of them. You look at some of these states, they are very dependent on GST revenues. What would be the impact there, and how does this impact their abilities at a time when, you mentioned this before also, at a time when REVEX is rising? A lot of subsidy programs, cash transfer programs are taking place. So how does this bake into that?
So the fiscal cost, at least as per our assessment of the GST cut, is more on states than center. That's because they have access to the GST revenue, a larger share. So states have SGST, which is their state GST collection, plus they get 41% of CGST, which is the central GST collection. So hence the loss of revenue for them will be larger. For us, let's say we've estimated on a 12-month basis, the fiscal cost to center will be 0.1% of GDP. The states, it will be maybe somewhere around zero point 0.4 percentage points of GDP. But this is a static assessment. It does not build in, let's say, a pickup in expenditure or consumer durables, because in response to tax cut, it just plainly captures the shuffling of items from the 28 to the 18, and from the 12 to the 5% slab bracket. So in a way, you can say this is the worst case scenario in terms of fiscal costs. Now, yes, you're right. Certain states are more dependent on the central distribution of central tax devolution. There's another yardstick. It's that transfers from center to state. That is also another one, that with the whole just-in-time cash management, where you're actually seeing the squeeze. So states which have where their own tax collection is a bigger share of their revenue will do obviously much better. They will be able to also spend and support their own individual state economy, because they will have less of a hit on the revenue side. I think we'll have to see how the state governments manage the cost. Right now, what you're seeing is, if you look at the bond issuances by state governments in FY 26, it's been higher than what we had expected. And this is despite the fact that state government cash surplus, which they invest as T-bills with the center, is still on the higher level. But states are coming more and more to the market, and they're borrowing, issuing more bonds. The second half of the year is where majority of your state borrowing comes in. 60% of issuance in second half is state, while 40% is center. In the first half, it's more center, 60% is center, around 40% is state. So that's how they kind of distributed between the first half and second half. Now, when we are entering the second half, when state government supply naturally picks up, if this, then you'll have this additional layer of sort of a fiscal cost for the GST. So we could see some upward rise in bond issuance. That's one of the reasons why the bond market reacted so negatively. The reason why the 10-year yield is up, it's not because of the hit to center. It's because the hit to states is a bit on the higher side, and state government bond supply, which usually picks up in the second half, could be, a bit on the higher side. So you're seeing this sort of the bond markets giving you that signal. So how they manage that. On the other part of the income tax schemes that, the targeted to, let's say, women, in many states, 14 to 18 states that have already implemented. If you see the burden that is budgeted in FY26 and that is budgeted in FY25, it's similar. It's not as a proportion of GSDP, it's not picked up. In absolute terms, yes, there is a positive growth rate, but it is in line with the state's nominal GDP growth. So those states are getting a lot of flack focusing more on these income schemes. If you look at the expenditure pattern in Q1 FY26, capex has been prioritized.
Thanks, Gaura. Thanks, Dheeraj, for coming on the show. We can discuss ad nauseum about these things. The problem is we're running out of time here. As far as India's rating upgrade is concerned, what Gaura said was, I think, to a tune, right, where she pointed out that although rating upgrade are important in an uncertain environment, the government also needs to support growth. Dheeraj also pointed out to the fact that the 6% target that the S&P sets is not basically very easily achievable. There has to be some draw from both the center and states that needs to be achieved on that. Thank you for watching the show. We'll be back next week with more news and analysis. Thank you.